Hello, everybody. All right, so let's talk about SPY. Man, what a crazy day today was. I think that this whole banking thing is going to get much bigger and go much farther, and we haven't seen the end of it. And there's going to be more banks that fail, and the market is going to go lower. Now, here's the SPY, right? I mean, my target here is for about 320. Now, I know generally I'm just a trader and I don't take long-term views. I'm more of a short-term person, but people have been asking me, like, where could this market go? Now, SPY is an ETF that it's a spider ETF. This is Standard & Poor's Depository Receipt. It's designed to track the S&P 500, which is the most important index or benchmark on Wall Street. Most firms, that's what their competition is. Institutional money managers, whether a mutual fund, a hedge fund, an institutional money manager, they have benchmarks, and the benchmark is something they compete against. So basically, pretty simple. If they have returns that are better than the benchmark, they've done a good job. If they have returns that are worse than a benchmark, they've done a bad job. There's a little bit more to that. You've probably heard a lot of academics talk about, oh, the typical Wall Street manager can beat the benchmark, blah, 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 blah. Well, that's because they don't understand. I mean, if you're an institutional money manager, you are beholden to your clients. And if the market is crashing and your clients get panicked and they call you up and they say, oh, I want our money back, well, you're forced to sell even though you think it might be a bottom. But anyway, obviously it's all about the banks. I think it's kind of astonishing the incompetence that we're seeing with our leaders, quote unquote. They were wrong about inflation. They've been wrong about this. They've been wrong about that. They've been wrong about the other thing. And now we're going to trust them to bail us out of this. That's why I'm not too optimistic. I mean, I hope I'm wrong, but unfortunately, I don't think I am. And I've been doing this for a long time, and I've never seen anything like this. See, the reason why the banks are in trouble is because interest rates are higher. Now, how does that happen? Some people will say, well, gee, Mark, aren't interest rates higher good for a bank because they can lend at higher rates? Yeah, up until a point, but we've exceeded that point. Now the costs associated with it are exceeding the profits. But in terms of these banks, now the Signature Bank, the Silicon Valley Bank, these banks are run by people that don't know what the hell they're doing. All right. Basically, they put all of their, well, not all of them, but a significant amount of their investments in government bonds. And when interest rates go higher, the value of bonds goes lower, right? Now, why do I say they're incompetent? Well, anyone who had a competency would have their portfolio hedged. Okay. In other words, if you have a $200 billion portfolio of government bonds, it's kind of like, oh man, I got all my eggs in one basket here. There's a chance that this basket goes down. So maybe I should hedge. What does hedging mean? Well, buying something that will go up if your portfolio goes down. An option trader will know this as a put, right? If the market goes lower, the puts will go higher. In the institutional world, they would probably go into the futures market, but it's the same point. These firms did not hedge themselves. And I don't know how they are the only people pretty much on Wall Street that didn't see interest rates going up. But when things are going well, and keep in mind a lot of these banks are crypto related, when things are going up, people can turn a blind eye. People are more, they're more willing to be like, okay, well, I don't see anything. I'm not going to say anything. But I think, in my opinion, that a lot of this comes back to this dumbass energy policy that we have. All right. When Biden came into office, he totally scared the oil industry. And listen, man, I don't want to talk about politics. If you like Biden, whatever, you know, just think about this. When Biden came into office, oil was $32 a barrel. When the Ukraine war started, oil was $100 a barrel. That's because President Biden literally said he was going to put oil executives in jail. And they don't want to increase production because if you were running a company and you were going to go start a well, would you start that well or dig a well if you thought, oh, gee, in 6 months they might put me out of business here? All right. So I can't say this enough because it really bothers me because there are literally people starving to death and there are little people dying because of this energy policy. It wasn't Putin's price hike. It was inflation that caused the war. Inflation is not a result of the war. The war is a result of inflation. All right. The Russian economy is run on oil, And when oil is $32 a barrel, like it was in the election, they are underwater. When oil is $100 a barrel, like it was when the war started, they are above water and they can afford to finance a war. So now this whole thing is bleeding over into the banking sector because when we have higher rates, the value of these portfolios that the banks hold goes lower. All right. So this just shows you how bad inflation can be. And now here's the problem. The you know the solution is okay, well we're going to backstop banks. We're going to bail people out. Well, guess what? Where does that money come from? They print it out of thin air. And when they print it out of thin air, it's inflationary. So we had a problem that is caused by inflation, and the solution is to do something that is going to make inflation even worse. So this is what I mean by we're between a rock and a hard place. So my guess is that there's more banks, more trouble over the next few weeks. Things will probably go lower. All right, so let's get to the S&P here. Now, we I've talked a lot about this whole the importance of the 390 level. Now, if you know stockmarketjobber.com, and you should, because if you want to learn how Wall Street really works and how trading really works, you should listen to what I have to say. I mean, I'm not a genius or anything like that, but I was in the institutional trading world for more than 2 decades, and I picked up a few things there. Now, look, one of the things I learned is some price levels are more important than others. You can see this 390 level, important there, important here, here. I mean, you don't need to be a former hedge fund trader like I am to see that this level is important. I mean, some price levels are more important than others. That's just the way financial markets are. So, all that being said, I think it's going to be pretty tough for S&P to get back above this level. Maybe it does. My guess is we get down to around 377, which is here, this former bottom. We get some kind of a bounce, but I think we start to roll over and go lower again. And I think we're probably going to break this, and I think the market's going to go lower. And I think that this whole banking thing is going to spread, and it's just the beginning of the next down leg in the bear market. All right, so all that being said, let me go on to the next thing here. Obviously, we need to look at the financials. So here is the financial sector. And now let's take a look at this here, okay? I'm going to go back to my pen and see support became resistance. This particular level for XLF, this is this ETF that tracks the financial sector, is important for some reason. I don't know why. You don't have to know why, right? I mean, do you know why electricity works or how electricity works? But for some reason, this was support. When the market's going lower, there's not enough buyers to support the sell-off. There's more supply than there is demand. So sellers need to force to offer shares out at a discount. That forces a downtrend. When the market goes lower, a lot of the people that bought over here regret doing so, and they tell themselves, "Man, I made a mistake. I am going to sell my shares if I can get out at break even. So if they get back up to my price, I'm going to sell them so I can get out at break even." So this is why support can turn into resistance. So this is the S&P financial sector. There's 11 sectors in the S&P 500. Obviously, the most important sector to focus on now is the financial sector. During COVID, it was healthcare, but now it's financials. So resistance became support. How does this happen? Well, buyer's remorse turns support into resistance. Seller's remorse turns resistance into support. A lot of the investors who sold regret doing so when the price goes lower, and they tell themselves, a lot of the investors who sold regret doing so when the price goes higher. And they tell themselves, I'm going to buy my shares back, but only if I can get them at the same price I sold them at. So we could see that some price levels are more important than others. You can even see up here, right? This level was resistance, 36, then it became support, right? Seller's remorse turns resistance into support. Now, here's why I think there's a good chance we can go lower. I don't really see any well-defined levels in here until we get down to here. And it doesn't seem like much. It's only about $2 on this ETF. But in terms of a percentage, that's a big move. Now, when we get down there maybe there's a rebound and maybe there's a chance to make some money on the upside. But what you have to do is wait for the actual rebound to start. A lot of people just try to guess and they try to catch the bottom, and it's basically impossible. If you want to be a successful trader, forget about being precise, forget about being right all the time. Just focus on making money. And if we get down to 29.70 and we rebound, and when we get to maybe 30.50, if it looks like the rebound is going to continue, well, then you jump in. Don't try to catch the bottom, because just because we're oversold and just because we're getting close to support doesn't mean we can't go any lower. So every chart teaches a lesson. We can see resistance, resistance, market memory, important levels can retain their importance for a long time. Support becomes resistance. Charts are a graphical illustration of human psychology. And you might be like, what the hell are you talking about? Well, guess what? It's human psychology that turns support into resistance. It's human psychology that turns resistance into support. Now, we get down here, it might be some market memory. Anyway, considering the sell-off we've had, the fact that there was really no bounce back today, that's what we call action. Action is something that's like not quantifiable, but the fact that we have such a big move lower and there's no signs of a bounce, not even the bottom feeders are coming in, it tells me that there's a good chance we can continue to go lower. Here's a pretty cool example of what we call market memory. I just said that levels that are important can stay intact for a while. Now look at this. You can amaze your friends with this, okay? Whoops. Pen. Look back here in late 2020, okay? 2.5 years ago. What was here? Resistance. Where did this ETF that tracks the banks industry? Banks are an industry. They're part of the sector, all right? There's 11 sectors in the S&P, and within those sectors, there are numerous industries. But look at where we found support, right at pretty much the same level. Here we have support, support breaks. When support breaks, meaning the price trades below it, it tells us, it tells us that the investors who created the support with their buy orders are out of the market. And whenever you take demand out of a market, it could set the stage for a supply to be forced to push things lower. All right, let's take a closer look at this. So here is the bank industry ETF. Look at where we got today, like to within a penny, okay? Now this is why I tell my students or my stock market jobber friends to stop worrying about dumb stuff like Elliott wave and Gann theory and harmonic charts. That stuff is science fiction. No one on Wall Street in the institutional world that I've ever worked with in more than 2 decades looks at that stuff. What do good institutional traders look at? What price levels are important? Now we just looked back 2.5 years ago at a support level. Now if you were trading, or if I was trading today, I would have said, oh, hey, we got down to a level of that support. There's a good chance we get a bounce. I would have waited for it to reverse. Maybe when it gets to 36, I would have jumped in, closed at 37. Might not sound like a lot to you because it's only 1 point. But if you're an option trader, that could be some real money. But again, not any kind of real bounce back. Maybe we get a little bit of a rebound. I don't know if it's going to be tradable. I mean, I'm sure it's going to be tradable, but you got to be pretty nimble. Me, I would not be long anything in financials because I think this contagion spreads, and next a news announcement of another bank going under, we could get a massive sell-off. So go back and check out my other videos where I talk about how this financial meltdown was coming. I started talking about it a week ago. I had no idea that this stuff was going to happen, but I thought the charts looked weak. And look at FAZ, F-A-Z. That is an ETF that will go up if the financial sector goes down. And not only will it go up, it will go up by about 3 times the amount that the financial sector goes down. Now, it's not a recommendation, but if things start to really fall apart, you don't need to hold your head in the sand. You don't need to go to cash. You can buy inverse ETFs and you can make money off of a move lower. And in a lot of ways, it's easier to make money off of a move lower because markets go down faster than they go up. So anyway, before I go, notice how resistance can become resistance, support, support, market memory. Support down here, as we saw with support 2.5 years ago. All right, everybody, that's it. So just be careful. Make sure you check back. I'm going to be talking a lot about this over the next 4 days, and I hope to see you then.